Hey guys, welcome back to another edition of the Trading Guys with me, Ryan Mack, and today I'm actually going to be briefly running over the directional bias again on the, not on the H4, but I do really want to press more on it on the H1, because as I was going through the last video, I realized that there is actually quite a lot that I could be discussing with you. You're probably, if I just left it at that one, 15-20 minute video, you're probably going to have many questions that I could actually answer if I just went through more of it and spent more time on the H1, which is absolutely fine. So now, without any further ado, in this video, we're going to cover more directional bias. I'm going to cover the EMAs. What is an EMA? The exponential moving average. And I'm going to cover what you are looking for in the days of movement. So, as a quick recap, have you identified what you're looking for in the H1? Have you identified the peak or the anchor point? Okay, yes I have. It's an anchor because it's at the bottom now. It's already ran. Okay, how many days does the market maker push the market in one direction before he gives you a correction or a reversal? Remember we discussed it's 3 to 5 days that he will push it in one direction before he gives you a correction or a reversal. Okay? Now, the difference between a correction and a reversal, in case anyone's wondering, if the market's here, right, and it's going long, he will push it for maybe 2 to 3 days. He'll pull back for 1 day to give himself more space for sales, to collect more contracts, and then he'll start pushing it again in the same direction. So it's not a reversal. The market doesn't reverse. It just gives you a correction. It pulls back for 1 day, and then it continues to run in the same directional bias going long, okay? Or going short, depending on which one it is. This particular example, we're talking about it going short, or going from the anchor point going long, okay? So then a correction is when the market comes down. Let's say it's, use the same example, let's say it's already ran short. It's now give us a beautiful anchor point at the bottom. It's ran for 2 to 3 days. It's gave us a pullback correction. It's then continued to run going long, and then it's painted a beautiful peak formation at the top, telling us that he's already ran for 3 to 5 days, right? He's already ran that run, and on there you're going to see like that's going to top out. It's going to probably give you a double top at the 200 EMA, most likely the 800 EMA, or the high or the low of the week, and then he's going to give you a correction. Then he's going to give you a reversal, not a correction, which means he's going to reverse the market. He's going to pull it coming short for 3 to 5 days again. And in amongst that 3 to 5 days, he will give you a correction. So if it's coming from high to low, long to short, he's going to bring it down maybe Monday, Tuesday, Wednesday, Thursday. He'll pull along, he'll give you a correction, and then he'll keep running short again, and he'll pull it down, and he gives you that continued run, okay? And then he repeats the process again. He doubles out at the bottom at the anchor, and he's going to start pulling it long. It just continues and continues and continues. Once you see it, you cannot unsee it. Now, if any of you guys really want some in-depth explanation about this, you can jump online, and you can find a guy called Steve Morrow. And he has hours and hours of videos. So most of the stuff I'm talking about is the same information that he supplies. He has like 4-hour videos that he's made, and he goes into this stuff in great detail. And he himself is an ex-market maker, and he has the playbook. He has everything there to show you in black and white. He is phenomenal. However, if you are new into trading and you just watch his 4-hour video, it is going to blow your mind, and you're just going to be sitting there like death by PowerPoint, okay? So my videos are for extreme beginners where pretty much anyone can digest it. And then later on, if you really want if you want to look at his stuff, you can look him up. Steve Morrow is fantastic, and you can have a look. You can even jump onto my Chief Traders courses if you wish later on, but of course that's not through me. You can buy them yourself, but that's later on, depending on how far you want to take your trading, okay? But I'm going to share heaps of stuff with you. Without further ado, let's get cracking. We'll jump on the screen and I'm going to show you this, all right? Let's go. Okay guys, let's have a look again. I just want to go over this again from the last one. I know we covered it, but I only covered a couple, and I really like to harper on and show you how often you see this. And sometimes you don't see it. There are two ways, and again, I know I keep covering the same stuff, but I really want to embed it into your mind. There are two ways in which the market moves, okay? There is market maker manipulation, when a market maker has a particular interest in currency pairs. Now, why would they do that? There may be big news coming out in relation to the USD, okay? So there could be Fed interest rates coming out and he thinks, oh, this is going to be a great time for me to make stacks of cash by manipulating the markets based off of world news. And that's exactly what he does, all right? Now, I mean, if we look here, it's the same one I showed you before, but we can cover it anyway because it's fantastic. We have the anchor point here. It runs long for 3 to 5 days, right? And then now he's painted you a new peak formation here. So what we're essentially looking for, we'll cover it more in the M15 in the next video, but we are essentially looking for this to peak out here, give us a fake move going long, and then running short, okay? Let's look at the next currency pair. Here we are on Aussie dollar USD. Look, have you identified? So is there a directional bias? Yes, the directional bias is running long. Okay, now has it? If this had only ran to here, then what does that tell you? It's gonna keep running long. Why? Because it's only ran for 1 day. How long does it run for before it gives you a correction or a reversal? 3 to 5 days. Remember? So here is your anchor point. In fact, let's go back one. Look, here's your peak formation, right? 1 day of drop, 2 day of drop, 3 days of drop, and then he gives you a complete reversal. 1 day of rise, 2 day of rise, 3 day of rise, 4 day of rise. He gives you a correction, not a reversal, but he corrects the market because he can't keep pushing anymore. He needs to make some space for buys and sells. And then, boom, 4 day of rise. And now he's going to peak out. Once you see it, you cannot unsee it, guys. Now look here. This is what we call an absolute mess. Now, one of the reasons why this is a mess, right, is that we would then say that there's not a lot of what makes a market do this, right, as opposed to do this, where you can see it. This tells me, or tells us, that there is market maker manipulation. Because it's textbook. Market makers must go by the guidelines, guys. They must, and because they use a rule book and guidelines for specific moves, it paints patterns on the market. So here you have an old anchor, all right, your old anchor point. 1 day of rise, 2 day of rise, 3 day of rise, gives you a reversal. Sorry. Gives you a reversal. 1 day of drop, 2 day of drop, 3 day of drop, gives you a reversal. 1 day of rise, 2 day of rise, gives you a correction, 3 day of rise, and now, look, now this is a total mess. Here you've got all the EM, what creates this? I would never touch this in a million years, right? Why? Because the EMAs are all far too close together, which gives you a ping pong ball effect, which I've said in my previous videos. And if you look at this screen right now, what is it doing? It's ping ponging between all the EMAs. So it's just so erratic, it's a total mess. Is there a directional bias here? No, look. It's as flat as a pancake. There is no directional bias here. I know it's going up and down, but that's not a directional bias. Look. Look, is there a directional bias here? Look, absolutely. Sorry. Absolutely, it goes long, you can see it a mile away. Is there a directional bias here? Absolutely, it goes short, you can see it a mile away. Is there a directional bias here? Absolutely not. So if I jumped on this pair in the morning, right, what I'm going to do is, my first thing, I'm going to look at the H4. Right, there's no Gartley. All I'm looking for is the W, the M, the bat or the butterfly, right? No, I don't see that here. Okay, so instantly I jump onto the H1. Is there a directional bias? No, that is a total mess. Can you see, have you identified a peak formation? No, I haven't, because it's just bouncing up and down. What you're looking for is an anchor or a peak. Do you see that here? No, there's nothing clear to be identified. So what does that tell me here, guys? That tells me that I am not even going to bother wasting my time on this currency pair. So I just scrap it for the day. I move on to the next one. There's no Gartley here. Let's have a look at the H1. Is there a directional bias? Yes, there is a directional bias. How many days has it ran? 1 day of rise, 2 day of rise, 3 day of rise, 4 day of rise, and look, it's been rejected 1, 2, 3, 4, been rejected 5 times at the exponential moving average. So you're looking, you now know that you're not going to take this short today. You're just waiting to see, because it's Monday, right? You don't want to take a trade on Monday, because look, he's just made a mess since Friday, and all he's doing is trapping people in, and he's going to hit your stop losses. Don't trade on a Monday or a Friday, all right? But just watch the markets and see what they do. Let's move on again. Here, H4, do we have a Gartley on the Euro GBP? Yes, we have a Gartley, fantastic, okay. Has it already ran? Yep, sadly it's already ran, okay. So we ignore that because it's already made its move. It's now moving long again. Let's look at the H1. Let's zoom out. Is there a directional bias? Not really. I personally would call this a flat market because it's just, look, it's just flat. I don't like it, there's no market. So I would just move on. I don't even waste my time going over anything else. Next, gold, half a Gartley. I don't really trade gold, but look, is there a directional bias? No. It's flat as a pancake. Look, there is no directional bias. I'm not going to waste my time here. Let's move on. Is there a directional bias? Nope, not going to waste my time. There's a Gartley, but it's already ran. H1, zoom out. Is there a directional bias? No, there absolutely isn't. Look, it's just a mess. This is not any directional bias. The market is just moving. This happens when there is no market maker involvement, when it's only people buying and selling in the markets, all right? When there's market maker involvement, it's much more fluid. You can see a directional bias, okay? I'm going to show you a better one. You can see the directional bias. Look, he plays it in there, all right? I mean, you just can't unsee it once you see it. Let's scroll through. I'll show you. Directional bias, look. Here's your peak. And you notice something else, look, he gives you double top. So we call this double top, look. He gives you a beautiful double. So when you see this, what happens is he makes this move to get people to buy in going short, and then look, bang, bang, bang. He pulls this up to hit your stop losses, and then he pulls it down. So that's why when everyone else is texting me, oh, I already made a trade today, and I'm like, yeah, I would never touch the markets today. The reason is being, I would never get in the markets here. What I would do is I'm waiting patiently for the double top. The minute I see this double top, and that's a double peak formation, I'm getting in around this candle here, and my stop loss is going to be 10 to 13 pips above here, okay? My take profit is going to be around 50 pips. There we go. Well, there you go. Look, it ran for 84 pips. My take profit is usually going to be around 50 odd, so I would get out around here. Get in after, slightly after everyone else, and get out before everyone else, okay? This is the golden tricks here, I'm telling you. Get in slightly after everyone else and get out slightly before everyone else, so you don't get bit in the arse. Let's go back more. Look at this. Is there a directional bias? Absolutely. Bloody beautiful going long. How many days has it ran? 1 day of rise, 2 day of rise, 3 day of rise, 4 day of rise, and then he gives you a correction. Boom, he reverses it, sorry, he brings it down. Gee, look, here's another peak formation. Look, he gives you a double top, and then he brings it back. So when people are getting in here, like, oh yeah, I saw that spike up for the price correction, I got in. No, don't get in. This is why I don't get in. You take your shots. You're looking for that precise moment. You're looking for the double top. Sometimes, guys, he can just make this run. He'll just go from here and he'll make it go. And you missed out on getting that trade. But like I said, who cares? If you miss a trade, who cares? If you lose a trade, that's totally different. And you will lose a trade if you jump in around here. You're waiting for the double top, then you want to get involved. All right? Look, 1 day of loss, pulls it back for a correction. 2 days of drop, 3 days of drop, 4 days of drop, and then he anchors it out again. And then what does he do? He reverses it out, and he gives you 3 to 5 days of rise before he does the exact same thing again, okay? Now go away tonight and check this out on your own computers and let me know how you got on at identifying these peak formations on the H1. Okay guys, see you soon, bye bye.